My name is Ivan Gaine. I'm Managing Director of Sherry FitzGerald New Homes and Commercial. I'm delighted to host our second webinar entitled Show Me the Money. Show Me the Money from the movie Jerry Maguire, which was released in 1996, so nearly 30 years old. I'm not quite 30 years in Sherry FitzGerald, but did start in 1999 and have seen a fair bit of ups and downs over the past 2.5 decades plus. Really, my job today is to introduce our panelists who put a lot of work into today and a lot of work into the industry over the past many years. First off, we'll hear from Andrew McKenzie, who's head of real estate within KPMG, where he's been for about the last 14 years. Andrew and his colleagues within KPMG were recently commissioned by Property Industry Ireland to prepare a fairly substantive piece of work in quantifying the quantum of capital required to deliver on the programme for government. So Andrew's done an extra piece of work in terms of the granularity of the different sources of funding and potential requirements that we need to attract. Next, we'll be joined by David Kelleher, who's a founder and shareholder of Warren Private, who we've done a couple of deals with over the years and have real estate investment across many jurisdictions, but are particularly active in house building in Ireland on the equity side. And finally, we'll be joined by Fergus Mangan, who I know back through his Ulster Bank days, his NAMA days, and more recently as head of commercial in HBFI to give that sense on the development and debt side. So it's a fine sunny day. We'll get through it fairly promptly, about 10 minutes or so for our panelists, and hopefully people can grab a bit of vitamin D towards the end. So without further ado, I'll pass on to Andrew. Thank you very much.
Thanks, Ivan, and good afternoon, everybody. So look, by way of introduction, Ivan's obviously referenced it, but I lead the real estate corporate finance team in KPMG in Ireland. We do everything you would expect in that role in terms of helping property developers and investors raise capital, whether it's debt or equity. And we do that across all of the main real estate sectors here in Ireland, but in particular in residential. And so we're right at the coalface in terms of both the challenges and the opportunities for capital deployment into residential real estate. And it was in that context that PII and Ivan asked us to do the report that he's referenced around the amount of capital that's needed to deliver on government's program, on the program for government's target unit deliveries to the end of 2030. So I'll give you a little bit of colour around some of the key points that came out of that report. As Ivan referenced, there's quite a lot of granular detail in the background, and I encourage everyone who's attending the webinar to get into the report and into the detail. There's a lot of valuable data that's there, but we'll give you key messages coming out of it. And then I'll give a very quick high-level context just around where debt and equity availability is in Ireland at the moment as a prelude to what David and Fergus will talk about during their sessions in Warren and HBFI. So guys, if you can go to the next slide. And again, thanks. So the first part of the report that we did was acknowledging state obviously has a target of 300,000 units to be delivered between now and the end of 2030. There's an exercise that was needed to understand how those units might be delivered across the 4 key tenures for residential development here in Ireland, being stock that's sold to private buyers, stock that we utilise in the private rental sector, including multifamily, PRS and purpose-built student accommodation, and what will ultimately be used for social housing and affordable housing. And so we would have taken the housing need demand assessment toolkit and estimated what that 10-year split is across the years on an annual basis and ultimately across the 300,000 units, and that would have been used to inform, I guess, the capital sources that are needed to deliver on those units. So we have kind of roughly the 10-year split being something along the lines of 36% of units ultimately to be bought by private buyers, 19% to go to the PRS sector, 36% to go to social, and the residual last bit, 8% to be used for affordable housing. If you can go to the next slide, thanks. So what does that mean from a capital perspective? We would have taken the Department of Housing's report that was issued in September of last year, where they put out data stating views on the cost of building both houses, being 3-bed semi-Ds, urban apartments, suburban apartments, PBSA units, duplexes as the grounding for, I guess, the cost of building units and ultimately the cost that parties that are buying those units would have to pay for them. And so that's the grounding for the numbers that are within this. But we've estimated both the capital that's needed during the development phase for all of the 300,000 units, but also the capital that's needed to own them. And the way that we've thought about that is during the development stage, there's capital that recycles here on an annual basis, but really developers need to acquire a land bank, both for the units that they'll deliver in any kind of one calendar year, as well as a forward-looking land bank so that they can bring schemes through planning, through detailed design, etc. And so we've estimated that at about a three-year land bank. And then obviously there's the construction finance, both their own equity and development debt that comes in on an annual basis. So roughly, we have the amount of recycling development capital that would be needed to deliver the 41,000 units that the state was targeting to be delivered this year. Obviously, I think in reality we won't get to those numbers, but we have that capital at something like 21.4 billion. With that stepping up to about 31.1 billion by the end of 2030 when we get to a stage of delivering 60,000 units. So very material sum, but a constant recycling in that as developers sell units, the capital can be reinvested into the development of the next unit. When you think about the ultimate investment ownership of those units, that capital sum is a far more significant number. Not that 31.1 billion is not significant, but it's a much larger number at about 140 billion needed to ultimately buy or own the 300,000 units that are forecast here, and which works back to a number of about 467,000 per unit, which when you think about it as a back of the envelope calculation gives you the right feel that we're in the right ballpark here in terms of numbers. So that's the big number. That's the number at the end. But really, I think it comes down to where is that sourced from and what tenures does it fund, etc. And so when we're thinking about private buyer units across the 300,000 units that need to be delivered, we see that is about 50.8 billion of capital that's needed. That'll obviously be split between the savings of individuals as they buy their houses and the retail mortgages that they draw down from the pillar banks and other mortgage providers. And that equates to about 8.5 billion on an annual basis. And so it's a big number. And clearly we'd need to see a step change in particular in the mortgage books of the banks. But I don't think capital is the main constraint there to parties buying those units. It's more the supply of units that's the issue. We know that the demand is out there. In sharp contrast, when you think about PRS, we have the figure, the amount of capital that's needed across the forecast period at something like 29.6 billion or 4.9 billion a year. That's a much bigger number than what's currently being invested into the PRS sector on an annual basis. We were only at about 250 million or so worth of new PRS institutional money investment during the course of 2024 last year. And so there's a very, very significant step change that's needed there. And obviously that's been a key part of what's been driving some of the policy reform over the course of the last 2-3 weeks from the state. What I would say is there are other countries in Europe that are attracting capital sums into PRS more akin to what we're targeting here. Netherlands and Spain both would have attracted about 3 billion last year. Germany would have attracted about 9 billion. Even the UK would have attracted about 5.2 billion pounds. So we're not getting our fair share of the pie when it comes to PRS investment. And it's a key piece of the puzzle that needs to be solved if we're to deliver on our targets over the course of the next 6 years. From a state perspective, we have the amount of long-term capital investment needed to come from the state for both social and affordable housing. It's something like 50.7 billion. That's about 8.5 billion a year on average through the forecast period. Very significant sum. I think everyone would acknowledge the state is obviously spending a very significant amount already on social and affordable housing. I think the budget allocation in 25 was about 6 billion. So whilst we're spending a huge amount, we're probably still not at the level that ultimately is needed to be required for where we're going. And I think what my takeaway is and what it points to is really there's a need, I think, here to try to crowd in private capital to supplement what the state is spending, because the reality is we've got other needs beyond housing for state money around healthcare and infrastructure, etc. And there's only a limited amount of tax receipts that are going to come through on an annual basis to fund everything that we need to do as a state. And then the final leg here, the final bit that bridges us to the 140 billion that's on the page there is there's an assumption that there will be some institutional money that comes in to own social and affordable housing, primarily assets that are leased on long-term social housing leases to the state, and or capital that comes into to fund star affordable housing cost rental units. And I would say that that's very much subjective all predicated on reform of the STAR scheme, which is currently not ultimately delivering the type of institutional investment that we're seeking. If you could go to the next slide, please. So very quickly, that we've seen the overall quantum of sums on the previous page. We see that as being at roughly about 38.5 billion worth of equity that needs to come in here, both for development investment, debt of about 73.2 billion and about 59.3 billion of state financing. From an equity perspective, it's obviously private individual saving, as I referenced, is a significant sum. There's a significant amount of institutional money to come in through core funds and pension funds and insurance funds into the PRA sector in particular. And we see that capital structure as being kind of roughly 50-50 between equity and debt to buy up those types of units. And then there's a big quantum of developer equity that's needed primarily to finance acquiring land bank and obviously ultimately construction at something like 16 billion. Retail mortgage is a very big sum at 41.9, and institutional loans is debt to be drawn both during construction and for long-term hold from the pillar banks, from alternative debt funds and the like. And then from the state perspective, there's obviously the sums that I referenced on the previous page, which are for long-term ownership from the state. There's additional sums that are required to come through from the likes of the Land Development Agency and approved housing bodies that are doing their own construction, not just acquiring units that are built by developers. And there are material sums, maybe relatively small in the context of the overall quantum of capital that we're referencing, but still material sums that need to be put to play across demand side supports like the First Home Scheme and the Help to Buy Scheme and Creekana, etc. So we have about 1.3 billion of First Home Scheme investment that needs to be put to play over the course of the next number of years, and 2.1 across Help to Buy. If you go next slide, please. So that's all the capital that's needed. They're the targets of units. There's obviously a question mark as to how we're going to get there and what the primary challenges are to delivering on our targets. And look, there's ultimately nuance and detail behind all of the challenges here and many more that aren't on the page. But at a very high level, I think it's helpful to think about the residential development market as being bifurcated between houses and apartments, because the constraints for each are actually fundamentally different. So for houses, they're profitable to build. The end user wants them. Private buyers see value in them. They're affordable. That market works from a financing perspective and delivers enough return to both debt and equity to see it built. Really, the constraint, I think, is around access and availability of serviced land or land with planning, some of the dysfunction in the planning system, which is hopefully starting to resolve itself through some of the reforms that are coming through. And very materially, there are planning regulations that see us unable to obviously build lower density housing in a lot of parts of the country. There's a need for higher density housing, and you can't build a three-bed semi-D everywhere, is the truth. So there's a constraint, and ultimately how much housing can be part of the solution here. And finally, infrastructure is obviously very material piece that needs to be solved as we grow here, whether it's across energy, water, or transport. I think when you think about apartments, conversely to houses, really fundamentally they're not viable for the most part for sale into the private market. The cost of building them remains higher than for the most part what you can sell them to institutional money or to private buyers for, or certainly doesn't deliver enough profit for developers to be able to compensate themselves and their equity parties. And allied to that, planning is a restriction and infrastructure is a restriction. So really the state is the primary buyer of apartment stock at the moment. And that's one of the key reasons why the number of apartment units that are being completed on an annual basis are declining and in reality may fall off a cliff during the course of 2026. So if we fly into the next slide, conscious of time, guys. So at a very high level in terms of availability of equity and subsequently debt on the next slide, really we see equity where developments are able to deliver the financial returns that are needed for equity investors, and where they have planning that for the most part equity is available. We can generally fund or help our clients source equity in the market. It's not overwhelming, but there's enough for current needs. Clearly that's predicated on the track record of developers and their ability to deliver on outcomes. That's key to successfully raising money. There are multiple large private equity firms that we know and are close to that are seeking to partner with a house builder platform and deploy very sizable sums of of equity into house building in Ireland. TPG obviously came into Avara under a similar strategy over the course of the last kind of 18 months. So there is capital at that scale that's out there, but they're seeking a platform and they're seeking control of a platform, and that's not necessarily so well aligned to the objectives of our developer community, which is for the most part really family run, sizable developers that want to run and control their own businesses. And so when developers are seeking that more kind of passive capital, or where maybe they're at a slightly smaller scale than the quantums that was referenced earlier, the number of parties that are available in the market to fund those types of schemes from an equity perspective gets much smaller, much quicker, and you're really limited to the family offices. Pearl Real Estate, which is a vehicle backed by ISIF and Bank of Ireland, and the guys in Warren, which they'll obviously get into the detail on, but they play a very important role in providing equity into some of our mid-sized developers for residential development here in Ireland. And then finally, guys, if you want to jump to the debt slide to wrap it up. So when it comes to debt availability for residential development, when you're thinking about land bank and the acquisition of land bank, I would say for zoned land that doesn't have planning, the pool of lenders is pretty small. During the period kind of post 2019 through kind of 2022, 23, when we had really serious dysfunction in the planning system, lots of judicial reviews around SHD applications, etc. There was a real retreat from the lender community from funding zoned land. There's probably been a step back over the course of the last kind of 12 months or so back into that market, but really by lenders where they're financing trusted borrowers that they're active with on other sites, and really usually in the context of them providing development facilities. And for unzoned land, there's really no debt market. Warren clearly an outlier when it comes to funding zone land, and a key part of the solution again in that segment. In contrast, for construction finance, for development finance, so where schemes are viable and they've got planning, it's actually a very competitive market. There's a multitude of lenders that are active here. The two pillar banks are lending and are increasing their loan book for residential development. Home Building Finance Ireland are a key player here and a really helpful source of debt finance. But there's also a multitude of alternative lenders and debt funds that are private equity backed for the most part that have come into the market. And so when we're raising debt for our clients, typically have a choice of parties to go to, and it's usually around strategic fit and pricing that's the key point of differentiation. So that's me, I think, Ivan.
That's fantastic, Andrew. Thank you very much. And we'll jump straight to David, and we'll take a wrap up then thereafter.
Okay, thanks very much, Ivan. So my name is David Kelleher. I'm a principal in Warren Private. We are a real estate company that invests third-party capital into real estate transactions. So if we move on to the next slide, please, Connor. So who we are. Sorry, one more again, please. So we're established in 2002. We invest money in Ireland, the UK, and the US, but 80% of the capital we deploy is into the Irish residential development market. We deploy about 80 to 100 million a year, depending on the quantum of opportunities that come our way. I think the KPMG report, it really called out some gaps in the market really well. We try and fill two of those gaps by providing debt and equity funding to experienced developers. In terms of debt, we're very specific. We provide land loans for residentially zoned sites that don't have planning. On equity, it's different. We provide site-by-site equity into ready-to-go development sites. Our definition of ready-to-go is that they have planning and that they have services available to them on a sort of normal economic basis. We're active across all parts of the market. We fund social housing, affordable housing, and private housing sectors. In the last 5 years, we've probably invested about 500 million, which has enabled the delivery of about 8,000 homes, give or take. So maybe we start with debt. So a common requirement on developers is to acquire land which is residentially zoned, but doesn't yet have planning. As you've heard from Andrew, most lenders don't like planning risk. We do. We've been taking planning risk in Ireland since about 2005. God knows the planning system can be time consuming and dysfunctional and ever prone to change. But what we've seen during all that time is if you have well-located residentially zoned land with services available to it, you get there in the end. So we offer loans of between 1 million and 15 million. The land tends to have a capacity for between 30 and 400 homes. If it has more than 400 home potential, it's normally the preserve of REITs and very large developers who have their own capital. We provide on loans, we'll give up to 60% loan to value, loan to purchase price, and the loans are tend to be 24-month terms. The reason they're 24 months is that's roughly how long it takes to get planning in a normal planning cycle. If planning takes 2, 3 months, 4 months, longer than that, that tends to be something we're not dramatic about. We lend nationwide. We're not just Dublin centric. We're land lenders only. We don't get involved in construction loans. That's not our area of expertise, and our capital doesn't work for that. So next slide, please, Conor, be great. So an example, Cronin's Wood in Killarney. Cronin's Wood, it's a 7.9 acre site on the outskirts of Killarney. It's a nice, relatively flat site. We lent money into an experienced residential developer who had a really good track record of getting good plannings. So they, subsequent to acquiring the site with the benefit of our loan in place, they submitted an LRD for 249 homes, which went through the system. Just anecdotally, the LRD system seems to have got off to a very good start as far as we're concerned. It replaced the SHD system, which plainly didn't work. The LRD system is working, is less prone to judicial reviews because third parties get to observe and object in a way that they're listened to along the way. It's a more democratic process, and the timelines are being respected. So in Cronin's Wood, when planning was issued, we got refinanced with a construction loan, actually from Fergus and HBFI, who's up next. Construction is well underway. It looks like it's going to be a very good outcome for the developer, for Killarney, and for HBFI. So we're delighted for that. So equity. So a common gap in the market. Developers often want to acquire and build out ready-to-go residential sites. So the first thing they need, or the ultimate thing they need, is construction finance. They've got to be able to access 100% finance on a construction program for hard and soft costs. In order to do that, if it's a social housing site or an apartment site specifically, they probably have to provide the site unencumbered. So they have to fund 100% of the purchase price of the site through equity. Even if it's a zoned or a feasible housing site, they probably have to come up with 35 to 50% of the purchase price of the site through equity. Many don't have sufficient equity, so they have two choices. They either let the opportunity pass them by, or they raise third-party capital. Normally, people raise capital, so common sources historically, friends and family, high net worths and family offices. They're a really important part of funding, and there's loads of developments out there wouldn't have been able to start without them. The problem is they tend to be capital constrained, and the people you're asking tend to be people who aren't in the industry, and perhaps they don't have the experience to underwrite it, and because they don't, they pass. Third part is institutional equity. That's very powerful in terms of the quantum. There's like a wall of institutional equity out there. The problem is, as Andrew alluded to and agree with him, they tend to want to go in at a platform level because they want to deploy large amounts of capital and they want to control. So as opposed to funding on a site-by-site basis, they prefer to, if a developer has 10 sites, they want to invest in his business, in his entire platform. Irish developers tend not to like that. They like independence and they prefer on a site-by-site basis. So how do we do it? Our equity works. So it's, at the risk of repetition, it's for ready-to-go residential sites. We invest 2 to 15 million per project. So we invest 80% of the equity is required. So if a developer wants to buy a site and he needs €1 million in equity, we'll put in 800,000. If they need 10 million, we'll put in 8 million. They have to put in the 20% balance. We'll do it on a site-by-site basis. We don't invest in platforms and company ownerships for a few reasons. Number one, we don't want to. It's too complicated. But number two, we're married to the site, and we're married to the capability of the developer on the site. It's an easier underwrite for us. We need it to be delivered via clean SPV. And we also need terms to be in place from a construction lender. There's no point in us putting in the equity if in the end the construction debt isn't available. Typical project size, 30 to 400 units. flexible enough an investment term, but it tends to be between 24 and 48 months where it works best. Our capital comes from private Irish capital, so fast decision making, and the decision making is vested in us. So maybe an example. So sorry, why developers choose our equity? First thing, it stretches the equity they have themselves. If they have €1 million and a site needs €1 million, they can either put in the entire million and own 100% of the site. Alternatively, they can put 200 grand into 5 sites. So it gives them capital firepower to do multiple deals or to do bigger deals that perhaps they couldn't afford to do on their own. It allows them scale. Next bit is, so we back talent. That's what we're trying to do. We're not developers, and we're not trying to be amateur developers. We're trying to find is good developers who are well able to deliver sites and good sites. They're the talent. We give them autonomy on site. If you're going to give someone money and they have an expertise, you need to let them get on with it. Because of that, we have some reporting requirements during the construction process, but they're limited. We align them with the construction lender. Construction lender will get a QS report and will get an architect cert at the end of every month. That's fine. That's adequate reporting. So we align with that. There's no additional layer for the developer. Again, at the risk of repetition, it's project specific, so that the developer remains independent on his other sites. So equity capital working with senior lenders. Senior lenders, I suppose Fergus will tell you in a couple of minutes, but senior lenders tend to see us as a positive rather than a negative. Why is that? If we're involved, they know that the site is adequately capitalized and it's got enough equity to build out the entire site. It's because we do our own thorough due diligence, and therefore, I suppose the senior lender has a second opinion. It's also third-party equity needs reasonable level of professionalism and governance in running the project, and that tends to be something which is compatible with what the senior lender wants to see themselves. Next slide, please, Connor. Thanks a million. So, yeah, a worked example. My mind works in examples. So we did a joint venture about 19 months ago with a very experienced Irish developer. As it happened, they had their own construction capability. If they didn't, that would also have been fine as long as the number works. We're more than happy with third-party contractors being involved on a fixed price basis. So we acquired a site with full planning for 40 homes. It was forward contracted to an AHB, so an approved housing body for social housing, subject to the normal HFA and CALF approval process. That's fine. That's a risk we're comfortable in taking. It needed 2 million in equity. We put in 80% of it, being 1.6 million. The developer put in 400,000. When we were organized, we got a 12 million construction facility from HBFI. Project duration was 24 months. It's within program. It's going to PC in about a month, and the sale to the AHB will be completed about 2 months after that. So how does the waterfall work? So when the sales proceeds are in, the first people to be paid off, obviously, are HBFI. Next people to be paid off is the 2 million equity. We get our 1.6 million back. The developer gets 400 grand back. At that point, there's about 2 million profit that's going to be remaining in the project based on current figures. So Warren put in equity on a capped but preferred basis. What that means is the next 650,000, the first 650,000 of the profit is ours in all circumstances. That's an 18.5% IRR, capped but preferred. So we put in 1.6, 18.5% annualized on 1.6 for 2 years is 650. At that point, all the remaining profit is the developers. So in this example, it's 1.3 million. So the way it works out, we put in 1.6 million, we take 650 of the profit. The developer puts in 400 and gets out 1.3 million. We're totally comfortable with that. We want a fixed return, and because we're happy to be fixed, we're preferred. We want the developer to do very well. Normally in the projects we backed, the developer gets at least half the profit. That's the way the numbers work out. So where are we active? There's a sample of some of the deals the JVs we're live on at the moment. We're building 26 houses in Limerick for private housing. We're building 42 apartments in Dublin 13, 50 apartments in Carlow, 54 apartments in Dublin 8, and 59 apartments in Dublin 15, all for social housing. We're active in a JV on 122 houses in Wicklow for private housing and 150 apartments and houses in Midlands for private housing. Again, we're not building them. The JV partner is the talent. They're building them. We're providing the equity to make sure that he can afford to make it happen. So, undoubtedly be delighted to see we've come to the wrap-up part. I suppose the KPMG report, it highlighted several gaps really well in the funding of residential development market in Ireland. We're just trying to help plug to them. Land loans on zoned land that doesn't have planning, and equity on ready-to-go sites. I suppose the point is relatively small money can make a big difference. What we've seen in our experience is, and actually when we're doing stats for this webinar, every 50 million that we put into land loans generates planning for about 2,800 houses. Every 50 million we put into phased housing sites, complemented with construction debt, allows the build out of between 2,000 and 3,000 houses, depending on phasing. We were doing it for a long time. I think we work collaboratively with developers. If there's a developer out there, you want a land loan or you want equity to make a ready-to-go site, we'd love if you give us a call. That's it. Thanks, Ivan.
That's great, David. Thank you very much. Nice and sharp and succinct, and some great messages landed there. So thank you. Last but not least, Fergus of HBFI. Thank you.
Thanks, Ivan. Thanks, guys. Thanks for the invite. You can move on there on the slides, please, Connor. I'll just start by on to the next one there, telling you a bit about HBFI and what we can do. I suppose conscious that there's probably some customers in the audience, but for those who don't know us, we're a state entity, but one with a commercial remit. All of our customers are private developers. So yeah, you have no more reason to come to me than you have to a bank or an alternative lender. So we have to operate with a commercial mandate in our funding, which we provide only for development finance. Unlike David and the Warren guys there, we can't take planning risk, we can't take equity risk. Our money is purely for the construction phase. And we've been doing that since we were launched in January 2019. As it says in the slide there, we have 730 million to deploy, which we're given by ISIF, our sister agency here. And one of the key messages I'd like to land with you today is that the availability of capital on our side is by no means a barrier at any stage. 730 million is obviously a finite amount, but by the nature of development finance, it's recycled. So we've already spent that more than twice over, and we'll continue to recycle it. So there shouldn't be any funding that we can't provide at any stage due to capital constraints. Another of the key messages I'd like to land is that even though when we were set up initially, I suppose the mandate or the messaging around HBFI was that we had a focus on small and medium developers. That was true at the time, and we still do today. But really, we have a whole of market strategy for residential development finance. We're happy to fund anything from 5 units up. Our only restriction is it has to be 5 units or more. And anything beyond that, whether it's tenure or location, is not a barrier to us. So we always try, David there mentioned gaps emerging or existing gaps in funding. That's changed since we started. And I'll go through how we've changed our offering in a minute. But as gaps emerge in the development finance market, we want to try and plug them, whatever they may be. So we're not going to stand still in terms of what our offering is today or what it has been in the past. So in that regard, feedback to us is hugely important on an ongoing basis. We're coming to the end of our 2-yearly review, which the Minister for Finance, our shareholder, does. This is the 3rd version of it done since we were established. And that takes in stakeholder feedback from a broad range of industry participants, developers, obviously, agents, debt advisory firms, competing lenders, everyone. And they provide feedback on what we do and how we do it. So, I would encourage everyone to continue providing feedback either directly to us or via government, so that we can best tailor our offering to make sure we continue to plug those gaps, which we believe we've done today. So if you move on to the next slide there, Connor, I'll take you through how we've evolved and try to tailor our offering as we've gone through our existence. So to go back to 2019, we had one product. It was largely tailored at house building for, as I said, small and medium-sized developers. But as you go through and as things change, particularly with the onset of COVID in 2020, we launched a time-bound and monetary limit-bound fund there, which is called a Momentum Fund for 300 million, which is tailored for pillar bank type customers. So it was a lower geared, lower price product. We deployed that quite quickly. It was closed and all repaid. As I said, it was a point in time which no longer exists, and we don't have that offering anymore. But as you'll see, we've launched specific products for social housing, which comes with a slightly cheaper rate and a cheaper fee structure, recognizing the reduced risk. We reduced our minimum size from 10 units to 5 following feedback from the industry. And then if you go forward all the way through to 2024, we did our first couple of transactions with the main other banks, AIB, Bank of Ireland, and Barclays as well, to lend into the 2 PLC syndicated facilities. And they're interesting for one reason mainly. It goes back to the feedback point I made a moment ago. We were given a recommendation by government in 2023 to step into that market. We in HBFI were pretty skeptical that we were needed. We didn't see a need for us in those facilities. But once we launched that offering, we had people coming into us almost immediately, both from the banks and the customers themselves. And we've done a couple of transactions there straight away. And we had predicted that wouldn't be the case. So it just speaks to the value of feedback to us, either directly or, as I said, to our minister and our Department of Finance colleagues. So maybe if you go on to the next slide there, Conor. Oh, sorry, I think there's a slide missing, but we have a slide there just in terms of our current product offering. I won't labor the point. The main point is it's all available on our website. I would say 2 things. One is we try to be as transparent as we possibly can in terms of our appetite from a gearing perspective, which is 80% loan to cost or 85% if we're doing the social housing, and our pricing. It's all there pretty clearly on our website in terms of our fee structures and our margins. But what I would say is, despite what I've said about our participating in the larger transactions with the banks on the syndicated facilities, 42% or almost half of our facilities since we started have been for 5 million or less. And if you work that back, that's about 20 houses and fewer. So, one of the jobs we have in our world at the moment is to get that message out there to the market a bit better, that almost half of the business we've done since we launched in 2019, which is over 200 facilities at this point, has been for 20 units or fewer or 5 million and less. So we will never jeopardize our support of the small and medium-sized developer and developments in favor of doing bigger ticket transactions. We want to do both. We have the capital to do both. We won't have a difficulty having sufficient capital to tailor our offering and cater to all ends of the market, and that'll always be the case. To talk about what we've done since we launched, these numbers are to the year end 2024. We'll be launching our half-yearly results in July, obviously, and we'll have gone from 2.7 billion in funding approved at the end of last year to slightly over 3 billion for the half year 2025. To touch on the amount of that money that's committed, at the year end it was 72%. On average, since we started, we tend to deploy about 85% of the money that we approve. We do lose ballpark 15%. Either they get better terms from another lender, or the deal doesn't go ahead for a different reason. We do convert a pretty high percentage of our approvals into actual drawdowns and supporting of homes. You'll see that to the year end it was just over 13,000 across 184 loans. That's now well north of 200, as I mentioned as well. One maybe call to action for the audience. You'll see there at the year end last year we had funding in 23 counties. We have a nationwide remit. I want to be in all 26. We've added 2 since the year end, and I'm left with Leitrim. So if there's any developers in the audience with a scheme that's viable in Leitrim, my number's on the end of the slides. Give me a shout. I'd like to make that 26 as soon as I possibly can. But genuinely, we aren't limited by location or indeed tenure, as I mentioned before. So we do want to plant a flag in every county in the Republic. The last point to mention there, and it's an add-on to the point I made about the small and medium-sized loans under 5 million. You'll see there at the bottom of that slide there, 2/3 of our facilities are for 50 units or less. So again, that really shows, I think, that we are catering to the whole market. We do large transactions, but equally we are agnostic on location, and we recognise that 15 or 20 units in a more rural regional town can be as impactful from a supply perspective as a couple of hundred in one of our bigger cities. So we do recognise that importance, and we do tailor to all ends of the market. Moving on maybe to some case studies there. Thankfully, I included the same one, or one of the same ones that Dave mentioned there a few moments ago. But there's 4 on the slide. I'll just focus on maybe the 2 on the right-hand side. One is a mixed social and affordable scheme in Westmeath. I'm fairly certain in saying that that was the first affordable launch that the Westmeath County Council had, and we did that about 18 months ago. And the main message I give to people on affordable schemes, from a funding perspective anyway, is that we see a broad range of approaches from the local authorities and how they manage these schemes, whether they want to sell the units themselves or let the developer manage that process, whether they're willing to provide a backstop for the units in the event that they don't sell or not, and a few other nuances. So if you're approaching us, or indeed if you're approaching anyone for funding, as much clarity as you can get from your local authority on how they intend to administer that is vital. I do recognise that's not always achievable, but that's a key point from a funding perspective. And then the bottom right, which includes the Cronin's Wood scheme that Dave mentioned, I think this is a particularly good example of HBFI and how we've evolved over time as well. We started supporting that counterparty back in 2019 when we were only a few months old. Initially, we provided funding for a relatively small scheme in a pretty rural part of Kerry, kind of 50 units, a mix of both private and social of units at that stage. And we've grown with that customer to the point where last year, we had done a number of different phases over a couple of schemes with them. We were able to provide a pretty significant facility to support that 240 odd units in Killarney. After Dave and his team had provided, a land loan to buy that land pre-planning, we were able to step in and provide a pretty significant facility in our world to build out that entire scheme, and it's going very well to date. So, I think it's a good example of how we've grown with our customers. Our customers have got more comfortable with us in terms of our execution and our turnaround, etc. So we've been with them and they've been with us since early 2019, and it's a particularly positive relationship and one we'd obviously like to continue. Moving on then to just a few challenges, and I'm conscious there's probably a good bit of overlap in this between both what Andrew and David have said and what I might say. To agree 100% with Andrew, there is very good availability of finance for housing schemes in particular from all segments of the market. And typically it's a case of pick your poison. Do you want higher leverage or do you want cheaper pricing, or what's your preferred option from a funding perspective? We do see good availability of debt finance for viable schemes. I would say it's obviously a bit slower in 2025. If you look at the HBFI pipeline, I was looking at these numbers yesterday, and our pipeline today versus 12 months ago is probably about 20% down, which is not good, obviously, from an overall industry perspective, because I believe it's reflected across other lenders, and I hear the same message from Andrew and his peers on the debt advisory side. On the balance of that, though, 12 months ago, HBFI was about to enter our busiest ever period in approvals and drawdowns. So, I'm comparing myself with our best ever 6 months, but still, it's not a positive indicator for the overall market. Andrew touched on the PRS market and how it's not being served. Equally, apartments on a build to sell basis, are a major issue. We'd love to fund more in that space. We've done very little. We've done 4 schemes of apartments on a build to sell basis, and I haven't declined any. It's just that no one is coming to me looking for funding for them, and totally understandably. They're all 4 of those schemes are relatively small. You're talking 20 to 40 units maybe, and all of them in pretty high-end locations in suburban Dublin where there's a clear trader down demand. So, schemes like Creekona need to be improved, and other measures. We've seen in recent days commentary around apartment standards, etc., maybe change, which may help rebalance that equation, but it's a huge issue. I'm not going to go into equity. Dave and Andrew have covered that very well already, and it's not a space we're in. Planning obviously remains a major issue, but I would agree again with Dave in terms of the LRD. The feedback we get from industry is that is an improvement, albeit from a low base, and hopefully that trend continues. Finally, the point I'd make there on cost of finance really is that even as Euribor and we lend over Euribor went up significantly in the last few years, overall cost of debt finance anyway, is still a relatively low component of the overall cost of delivering an overall scheme. Based on our schemes that we funded, it's about 5%. Now, I would say that's for housing. Obviously, for apartments, it's closer to 10 or maybe even higher. Our pricing, it's mentioned on our first slide. Despite being a government agency, I don't borrow for a zero and lend for zero. I'm subject to state aid constraints, and we have to do an annual exercise, which Andrew and his colleagues assist with, to benchmark our rates, both from what I borrow from ISIV at, and what I lend to the market at. So unfortunately, our pricing is somewhere in the middle of the market, relative to the banks at the cheaper end and the private equity lenders on the far side. We're not return driven. We will try and be as competitive as we can be, but we can't stray outside the guidelines we're set from a state aid perspective. But I would say that, viability as we see it isn't materially impacted by the cost of finance, particularly for housing. On the last slide, just to sum up, in my view, like, our job is to make sure finance isn't a barrier to bringing on supply. So we will try, as I've said, to plug gaps wherever we can. I mentioned our 2-year review and the importance of industry feedback. So whether it's good or bad or indifferent, we want to hear it, and we would encourage the industry to continue providing it through whatever avenue is sufficient or is available to you. And as I said at the very start, key message from me is availability of capital will not be an issue for me in providing funding. Whether you're building 5 units or 500, we'll have the capital available to support that scheme. So please come and talk to us. My number, etc., and the business development team is on the slide. So we're available at any time. And thanks again to Ivan for the invite.
Fergus, thank you very much. Huge amount delivered in a short amount of time. I'm just going to wrap up, and I suppose a couple of brief observations. Like, first off, I found it incredibly insightful. I think the report prepared by KPMG is really important. It's a model. It's not perfect. The HNDA you can debate up and down. The cost you can debate up and down, but it is there as an aid and a tool, and it's been very well received by government. I think overall we've seen a cadence and a pickup in the frequency of announcements, and we're not going to be perfect, but we are getting better. And I think we're taking, very clear steps in the right direction. Croí Cónaithe, we've launched an amount of product with Croí Cónaithe this year, and we've seen really strong performance. As a business, we've sold nearly 1,100 new homes, $500 million in GDV year to date. The customer that we're aspiring to serve, needs stimulation and support as well. And I suppose the narrative has been really heavy on the negative. I think the NPF is going to be incredibly important, and we're waiting for the Section 28 to come through. And in terms of the scale of ambition, we're going from approximately 400,000 unit capacity in on-zone land to 1 million plus. So we need to plan for 80,000 per annum for the next 13 years, and the government have been clear on that. But I suppose getting that collective buy-in is really, really incredibly important. So look, the money is there in the right locations, and I think the cadence that the lads discussed is really, really positive. On Fergus's themes of feedback, we welcome your feedback on the webinar. We'll be doing some more after the summer recess, and to try and kind of encapsulate everything that's been announced. But I said I'd try and keep it to time. So thank you to Andrew, Fergus, and David, and thanks to my colleagues in the background for all their coordination and marketing support and technological support as well. So appreciate it, and hopefully you get a bit of a breather and enjoy the summer. All the best.
Thanks, Aaron.
Thanks, guys.